Good evening, everyone. I would like to welcome all of you in the name of Junior Consulting and Hermes to the second workshop of our investment track. Tonight will be all about passive index investing and will be given by Sebastien Aguilar. Like Tim Neesmans mentioned in our previous workshop, passive index investing is the best option for most people, which is exactly what Sebastien is trying to convince people of. Sebastien has dedicated his life to helping people get the better of their finances by promoting index investing. And that is exactly why he's here tonight. So without further ado, I would like to give him the word.
Thank you, Gust. Welcome, everyone. I'm glad to be here. Should we still wait for a little bit for more people, or you okay to just go ahead?
No, I think let's go ahead and other people can still join.
Yeah. All right. Yeah. So welcome. I'm gonna share my screen. Yep. Here we go. Right. So when I share my screen, I don't see very much what's happening in the chat. So please don't hesitate to interrupt me. Like everyone, this is a very interactive session. I'm hoping that I can help you think about some of those big questions that are related to investing and life and freedom. And we'll actually start by some brainstorming, some big questions, and then there will be more. There will be time for questions at different points during the event. You can ask questions in the chat, but I will not read them as I speak. And then later, Hughes to someone else can just let me know what are the key questions. I will speak about different topics today. Investing for freedom is like the best way for me to summarize what I do. As Chris said, I have spent now the last 5 years helping people to invest in a better way, not to get rich, or not only to get rich. some people just come for that, but mostly to enjoy life, and through basically by building security and freedom. Right. So my goal is not to make rich people richer. My goal is to give people more time, more opportunities, so that they can be more fulfilled. At some point in this presentation, we are going to use a tool that is my fire calculator. I invite you to already go and download it now. I'm going to put it in the chat. Here we go. So, yeah, I wish. Yeah, that's not in a hyperlink, but you should be able to copy paste this into your browser, and then based on that, yeah, you will have access to a tool that we're going to use later today. At the same time, if you want, you can subscribe to the newsletter so that you get more information from the work I do. You can join future events that we have with the community, etc. Highly recommended indeed. Let's go back to this. I'm just going to close the door and I'll be back in a second. Right, so before we start, the usual disclaimer, I'm not a financial advisor. I am not a financial professional. All I do is share, common knowledge, my own experience, in the hope that it will help you better understand how to use money. Don't sue me, because I don't take any responsibility for what you do with your money. You are fully responsible for your own financial decisions. I'm just hoping to give you some wisdom. Right, so let's start with the first question. What comes to mind to you when you think of stock market investing? I suggest we do this in the chat. So if you could just chat and share share your thoughts. What comes to you? What comes to mind to you when you think of stock market investing? Obviously, you guys have had already a session with Tim before, but like, just what are the keywords or the key emotions? Maybe what have you heard about the stock market? Putting money to work, buy low, sell high. Very good. How many are we? We are 51. So there should be at least 49 responses here. because you all have a mind. So what comes to mind when you think of stock market investing? Making profits on short and long term. Nasdaq, Nikkei. Yeah, very good. Passive income, complicated stuff. Earn money while sitting at home. Losses. Passive income, risk diversity. Yeah, very good. There's still 40 people who haven't shared. Uncertainty. Yeah, yeah, yeah. There's a lot of that. What comes to mind? Portfolio. It's okay if you repeat what someone else said, right? It's whatever comes to you. You just type it and share. If something comes a lot, then it just means it's something that's quite common. Risk management, red and green. Yeah. You need to have money first to do it. True. Passive income. All right. Turbos. Yeah. Risk. Yes. All right. All right. Very good. Well, thanks for sharing. We are going to cover all of these topics today. So perfect. Now, my next question is, what would you do if you didn't have to work for money? And for this question, I suggest we do something slightly different. We're going to go into breakout rooms. So since we are about 50, I'm going to make 10 breakout rooms. So we should be about 5 in each. So here, the goal is for you to just share what you would do with, you share in that, you will be in groups of 5. And I'd like you to think about what you would do if you didn't have to work for money, which is kind of an odd question. And we'll do that for 2 minutes and then we'll come back. Yeah. And when you come back, you'll share again with everyone. All right, let's do it. So you've been invited to join the breakout room. I hope you can simply do it. So you should be able to accept. All right, everyone, you should have received an invitation to join the breakout rooms. I see that there's still 18 of you in here. How's it going? Yeah, I think most of you are finding your way. There's 12 people left here. Everyone, simply accept the invitation to join the breakout room. Okay, some people might not be around. That's okay. Or if you're not finding the way, just let me know and I can try to move you into a breakout room, but just you have to turn on your mic and let me know. Hi, everyone.
Hello.
Hi, how's it going? So you're supposed to turn on your mics and then have a conversation. How's it going?
Good, good.
So
nobody's speaking for now.
Okay, so what would you do if you don't have to work for money? Maybe you can
travel. Yeah, only travel.
Travel, yeah.
Yeah, that's the best thing.
That for sure. So you travel, yeah?
I'm sorry, yeah. I think I would do a lot of jobs, each month another job.
Yeah.
So you have the possibility to not be engaged with the same company for whole your life. So you can switch companies and switch the work what you're doing.
Yeah.
I think that's unique.
Yeah. I mean, you'd get all sorts of experiences, right, by doing that?
Yeah.
Okay, Heel? I don't know how to pronounce your name, I'm sorry. But all right. I'm gonna go see in some other rooms, yeah? But like, I don't know if this is working, people sharing in these breakout rooms. I'm gonna see how the conversation going in other places. Yeah, I'll be back. Well, no, I'll call you back to the main room in a minute.
Okay, thank you.
Okay.
Yes. Hello, guys. How's it going, the conversation? Okay, never mind. I'm gonna bring everyone back into the main rooms. Yeah. See you in a bit.
Sebastien, you're muted, by the way.
That's funny. Everyone who comes back into the main room is muted. Yeah. So that was just an experiment to see how this works. But has there been conversations in some of the groups? We're still missing some people, but they'll join soon. Yeah, I think some people are still having a conversation. Cool. So what were some of the answers that that came in the conversation you were part of? Travel? Going on vacation, yeah. What else? Investing in startups. Okay, that's cool. Yeah, if you have a lot of money, you can invest. Set up something similar as Bill Gates Foundation. I love that. Okay. Okay. Helping others. Yes. Yes. If you don't have to spend time on trying to make money, then you can think of other stuff, right? Investing in new products. Travel. Yeah. I've heard travel also in the meeting room I went to. What else? What else you guys speak about? I mean, there's some of you just joined. I think you had an interesting conversation. Support local support team. Yeah. Keep at your current job. Yeah. If you love it, just stay there. Right? Just keep working if you're not as stressed and you don't have to work as hard. Very true. You can create jobs. Yeah, you can actually help other people have a good life, right? And if there's a need for jobs, you can do that. Awesome. I love your answers. This is really, really cool. Can you still see my screen or is it not shared anymore? I think it's not shared anymore. I'm just gonna go back there. All right, let's do this.
Yep.
And then the last question is, what's the most important thing in life? This is a really complicated one. But like if you had to pick, if you just had to say something like what's most important for you in life, something just in a few words, like having fun. Yeah, I think that's super important. Health, being happy, health. Yeah. Well, that's happiness. All right. Relationships, enjoy life every day. Family. Yeah, love it. Money is important. Happiness. Yes. Challenges, family. Yes. Yeah, I know someone who says that money is the most important thing in life. And it's worth bleeding for money. So that's the views of a friend that I interviewed yesterday. And that's okay, because money can do a lot of things for you in life. Enjoy every day like it's your last. Yes, carpe diem. That's obviously something important as well. You have to find, I mean, in my case, I like to say I like to find the balance between the two. But yeah, definitely super important. Thanks for that. So, all right, let's get started. I mean, you shared a lot with me. Now it's my turn to share with you. So obviously this is not for you because in 2000 you probably don't have 10,000 euros, but I have to look at real data because we don't know the future, right? But let's imagine you had 10,000 euros in 2000 because you had already had a job and you could invest. Well, for most investors, this is what happened. They put 10,000 in some investments and today they have 14,800 euros. And this is, discounting for inflation. Anyway, you guys, some of you will understand that. But basically, it's not very much. Now, what the market actually did is far better than that. If you had invested in this 10,000 euros in the entire stock market, right, without basically in the most optimal way, then you would have gotten 32,000 euros. Now, what I talk about is, okay, what happened to this 17,200? How can we bridge this gap? And basically what I'm going to share with you today is this. Index investing is the way to bridge this gap, right? So index investing is a technique that helps optimize your performance and your investment returns simply by trying to track the market, to stay as close as possible as the market and avoiding all of the problems that happen to most investors and that lead to poor performance. When we're gonna go into this much more details in the second part of presentation. Right, I forgot to introduce myself. My name is Sebastien. I am actually an ex-consultant in energy management and sustainability, and I have I graduated from the University Catholique de Louvain in 2008. So that was 12 years ago. I'm not that much older than you guys. I did study engineering, but I think most of my stuff would have been the same if I had been in business or law. Basically, I was a consultant for most of my career. I did study a second master's in the UK at some point, so I took a break to do that. But when I started my journey 12 years ago, and even less than that, like in 2011, really, that's when most of things changed. But in 2011, my view of money was that it's this thing you need to pay your bills. No? And in 2011, I was just finishing an internship abroad, and I was paid very little. It was a hard time after the 2008 crisis, so work wasn't easy to find, even as an engineer. And I was in a tough situation because I was abroad. I didn't have money enough to bridge the gap between the end of my internship and the next job that I actually had landed. My savings were drying up, and I was abroad, so I had no social security. There was no chômage. I had no pension. And I actually had to borrow money from my little brother to be able to bridge the gap between the time that I was finishing my internship and the time that my job was starting. And I couldn't pay for rent, so I went to one of my friends' place, and he had a spare room, thank God. He didn't ask me to pay for anything. I was just crashing in his spare room and cooking in exchange. So that's where I was in 2011. Now, I was pretty much clueless about money, to be honest. And something's changed, obviously, over time, which is why I'm here today. This is a picture from last year. This is me and my wife and our first son. We basically, this is basically our life most of the time. We don't work anymore. We don't have to work anymore. About 3 months before our son was born, both me and my wife, we stopped working because we don't need to anymore. And we began living as early retirees. We basically live from our investments, right? And who's this familiar with this? What we've applied basically during the past few years in our life is we've applied the principles of financial independence through a simple method of index investing, which led to us having enough money in the stock market that is working so hard for us that we can stop working. And what's really strange about this is that most people don't believe our story, right? Because we didn't do anything crazy, really. It's not like we came up with a super popular app or some super disruptive technology, or we didn't launch any big startup that made millions. No, we worked as consultants, engineers. My wife is a construction engineer, and we worked just normal careers. We worked hard. We did climb the ranks, and we were rewarded for the value that we were providing to our employer. But our key secret was in being both valuable at work and living simply, focusing on what was really important, right? And this picture here really summarizes everything that's important to me in my life right now, right? And that's taking care of my son, being there with my wife, spending time with my family. My parents are getting older. I'm spending a lot of time with them. And then trying to give back to the community, right? Which is what I do here tonight with you guys. And this is just 7 years later, essentially. So me in 2011 being broke, and then me stopping work in 2018. So that's 2 years ago now. It's just 7 years. And yes, it's very short, and it's just crazy that we didn't do anything incredible. There's no, it's not like we haven't done anything that only us can do. We've done something that everyone can do. And so that's why, the message that I have to share with you today is so powerful, is because it's replicable. It worked for us. It will work for you. It's just a matter of time and of knowledge. And so, obviously retired in 2018. That's 2 years ago. A bit before that, in 2015, I started sharing some of my knowledge with other people. First in my living room, and then the group grew, and so we ended up doing bigger events. So this is one of the events in 2017, 100 people. This is another one the same year, 500 people, and it's the same message as what I'm going to share with you today. And I've been doing that since then, right? I mean, I've been doing some of that, and some other stuff too. But so today my mission is simple. My mission is to give you guys back your autonomy, so that you can actually work on being fulfilled in your life by focusing on what really matters. Like my goal, as I said earlier, is not to help rich people get rich. My goal is to help people be able to pursue their dream, to have time, have choice, so that you can focus on what really matters. And when I asked the question, what's most important to you? Some of you said family, some of you said health, some of you said relationship, some of you said money. Well, all of that are good answers. You know, what matters is that you can pursue what's really important to you. And I do that by helping people get the performance in the stock market that they deserve, because as we've seen, the markets have been doing great. What's happening is investors are not getting those returns. And I'm helping people build security and freedom in their life so that they can make decisions based on their real values rather than on the need to make money. So that is basically a summary of what I do. Right. So I spoke about financial independence. A lot of you probably have an idea of how that works. You've spoken about passive income. So yes, basically, financial independence is when you have enough passive income to cover your living expenses, right? So if passive income is higher than living expenses, then you're financially independent. That is the basic formula. It's super simple. It's super simple. Now, obviously, under this, there's a lot of stuff. So we're going to explore some of that right now. How to get there faster, right? So building passive income is not something easy. Most people never, ever have a single source of passive income in their entire life. So you have to start somewhere. And then once you start, you think, okay, how do I get there faster? So to get there faster, obviously, generating more passive income. If you don't have any, you have to start somewhere. If you already have some, the key is to grow that. So one of the key components of generate passive income is to earn money and earn more so that you can invest more. And to earn more, for me, there seems to be these are the two main ways of earning more, right? Getting paid more at work, so getting a raise or getting a better paid job, or launching a business or a side hustle to start generating income on the side. These are the traditional ways. There are probably other ways, but these are a bit more like tried and tested, and there's a lot of information about how to do this. And then the other side of this side of the equation is investing wisely, right? So if you earn a lot, but then you invested in something that crashes, it's useless. You didn't generate any passive income. So investing wisely, that includes, in this case, like the most common approaches are passive low cost index investing, which is a very good way of doing that. And smart real estate investing. I'm saying smart because not all real estate investing actually work in this case. There are other ways of generating passive income, but for the sake of this conversation, we're going to focus on these, right? Now, reducing living expenses is the other side of the equation of the financial independence formula. And there are different ways of doing that, right? My approach to this is to say that there's two types of changes in living expenses. The first type is structural changes. So structural changes is when you make a change in your life that has a lot of implications. And typically that would be housing, location, and transport. So housing, moving from a big house to a small house, right? Moving from a city center to somewhere a bit further. And maybe that increases cost of transportation, but maybe you move next to public transport, or you find a way to be able to go to work by bike, right? Instead of taking the car, or you find a way to work remotely, which is becoming more and more common. And hence that means you can live in a place that's really cheap, which means you remove the need for transport and you actually enjoy cheap accommodation in a cheap location, reducing your living expenses drastically, right? So this is probably the most powerful way of doing that in terms of being able to reduce living expenses, is to think about those big structural changes. The next piece is the mindset changes. And here it's not about seeing saving money as scarcity. It's not about trying to prevent yourself from enjoying things, right? You don't want to see this as a sacrifice, but more about thinking about what is important to you, right? And that is the valuist approach. Is what in your life has the most value. Once you've figured that out, as for example, for me, it's time with my son and my family. Once you figured what's most important to you, then find a way of doing a lot of that, right? Even if that costs money, that's okay. Money is there. It's a tool basically for you to get what you want and what you need most. right? And so think about what you value most in life and then spend on that, or spend on that, or just be smart about how to get that and get what you need, right? So for me, that's time with my family and my son. That doesn't cost me anything. I'm kind of lucky, right? I do value travel a lot. And when I was traveling, I did a lot of travel. I was smart with the way I was approaching these things, because what I valued in the travel were the experiences, the new scenery, meeting people. It wasn't, the fancy hotels and the completely empty beaches on the other side of the planet. So I focused on what I valued most in travel, and I just realized it didn't cost that much, right? Another approach to all this is minimalism, and that is basically getting rid of stuff that's cluttering our life, right? And that typically also leads to reduction in living expenses. Not always, but sometimes, and I would say often. Now, it's important to work on both sides of this financial independence formula, because passive income, it's important to work on that in the sense that there's no limit to how much you can earn. And the key to actually generating passive income is to actually educate yourself, think critically, and work hard. I mean, that's how you will earn better paid, income. How you're gonna get the next job. That's also how you get a degree in the first place. That can then lead to a well-paid job, right? So generating value takes effort, and it's important to keep educating yourself. On the other side, we have living expenses. Reducing living expenses has a double benefit, right? At the same time, as you reduce your expenses, you increase your savings. So every time you don't spend 100 euros, that means you have an extra 100 euros to invest and to generate extra passive income, right? And at the same time, as you reduce your living expenses, you also reduce how much you need to survive, which means you don't need as much passive income anymore to match those living expenses, right? Someone who needs 3,000 euros a month will take far longer to get to financial independence than someone who needs 1,500, simply because the amount of passive income required is double, right? So it doesn't mean it would be double the time, but it will take longer. So it's important to work on both sides, right? As you reduce living expenses, you free up some money, which you can invest in a smart way. As you increase your income, again, you increase the amount of available money that's there for you to invest and generate passive income, right? So this is a financial independence formula. I hope it's clear, and I'd like to invite you to ask questions. If you have any, this is a good time. Are there any questions? Feel free to turn on your mic and your camera and let me know if there's anything. If there's no reaction in 20 seconds, then I'll just move on. Are there any questions in the chat? I don't think there are, no? No. All right, then let me ask you another question. Is this useful so far? Or are you falling asleep? If it's useful, just let me know in the chat. That's okay. All right, let's do it. Thanks. Just to check that everyone's still here. And we'll get to Stan's question later. All right, let's do this. Now, let's talk about investing. When I started thinking about, creating a pension for myself and creating passive income, I was abroad, so I didn't have no easy access to the Belgian pension system. So I was kind of forced to do this. And I did explore the different approaches to investing. This table is sort of an attempt to summarize my perspective on the most common ways of investing. So the first column is what I call DIY real estate. So this is when you do it yourself. And this is traditional real estate in Belgium, not buying your own house, but buying apartments or houses that you will then rent out, right? The second one is DIY stock trading. And this is more when you try to pick winning stocks and you will buy them low and sell them high, right? And you do research to either select specific stocks or select specific sectors, maybe some ETFs that are targeted into specific things. And then you invest in them because you believe they will do better than the rest, right? So this is what I call DIY stock trading. It's an active approach to investment. Now, you can also invest through a bank, right? This is how most Belgians deal with their investing. They just follow what the bank advises them to do. And this is what I call delegated investing. And it has a bunch of pros and cons. And then the last column is do-it-yourself index ETF investing, which is a passive approach, which is the one we're going to talk most about today. So as you can see, I've selected, I've decided on a bunch of characteristics that to me are quite important. The very first one, it's not because it's important, it's because it gives you an idea of why people do what they do, right? So familiarity, most people understand real estate, but that's simple because people understand housing and they understand that if you own a house and you can rent it out, then there's an income. Simple, which means a lot of people actually go and do that, right? Stock trading, most people are scared. Yes, because it takes a specific knowledge to actually do this successfully. People are also scared because there's a bunch of gurus out there that are teaching techniques and that are making more money from teaching investing than from actually investing themselves. And sometimes it leads to scam, pyramidal schemes, and all sorts of scandals. So it's scary. It's also scary because there's been market crashes in 2008, the last one, where a lot of people lost a lot of money, right? So it is scary. And there's something scary as well when you invest through a bank. But at least there you are delegating some of the decisions to a professional or to several professionals. And so you hope that you will get good service for the money you pay. And that someone that has a knowledge will make good decisions for you and help you out. Now, that's what most people believe. In practice, it doesn't work always that way. And then we have the DIY ETF, index ETF passive investing, which is something that most people don't know exists. Now, that's why I'm here today. And yeah, hopefully I can help you uncover how this whole thing works so they can use it in your life. Right. Now, I'm not going to go through each of the different characteristics of all the different characteristics that I looked at for each of these 4 investment approach. But what I wanted to highlight is the benefits of DIY index indexing, right? So do you see there's a lot of green stuff there, a lot of green boxes. And basically for me, in short, right, returns typically higher than any of the other ways of investing. Volatility, a little bit higher than real estate, but typically less volatile, so less risky than stock trading, for example. Costs, super low, much, much lower than any of the other ways of investing. The time required to learn and start, a few weeks. A few weeks to a few months, depending on whether you do it on your own or you do it with someone that helps you or a group that helps you, right? So if you do it with a group or a coach or something, it can be done in a few weeks. How much time does it take to actually maintain? Just a few minutes per month. Whereas obviously if you invest with your bank, you have nothing to do. But if you do stock trading, typically there's work daily. And if you have real estate, then at least a few hours a month, sometimes much more if there are problems. You have access to your capital right away, which is not specifically a benefit, but it is a characteristic. You don't need very much money to start investing in index ETFs. With the 100 euros, you can start investing and it almost costs you nothing. Right? It will cost you less than 20 cents to invest 100 euros today. It's really, really, really effective. Whereas most of the other ways of investing will cost you more, it will cost you more and it will require you to have a bit more, right? So the bank will not start investing your money if you have only 100 euros to invest, or well, I might be wrong there. I'm not sure. I haven't asked them in a long time. In terms of diversification, index investing provides the highest level of diversification. Sometimes investing through your bank can lead to something like that, but typically banks will not do that for you. So it might happen only if you really try to do it. And obviously real estate will be super focused, right? You will have all your eggs in one basket at first, and then maybe you'll get 2 baskets or 3 baskets. Whereas if you go with index investing, in one transaction from the first 100 euros, you get thousands of companies. So you're widely diversified and it reduces your risk massively. Other key benefits of investing via index ETFs, it's simple and effective, it's quick to learn. You can start with small capital, high returns over the long term. And the only drawback is you actually have to learn. And it's not very difficult, but you still have to make the effort. All right, let's go into index investing then. So what is index investing? Index investing actually started to come together in the 1950s based on academic research. And there's been since then decades of academic research done in that field, typically financial economics, which has led to more and more academics to understand that index investing is the best way to invest. Obviously, that doesn't that doesn't work well with the financial industry, because the financial industry doesn't make money from index investing, which means the financial industry has always been fighting against this trend and against the evidence, right? So index investing is something that is built on very strong evidence based on historical data, which again and again prove that the best way to invest is to simply buy the market and buy and hold the long term. There's, among other things, there's been Nobel Prize given in 1990 to 3 gentlemen who did a lot of work that was the foundation of index investing. The first paper from these 3 guys was in 1952, and then all of them actually worked on those models, which are the foundation of index investing. In 1975, the first index fund was established, and it was put in place by a man called John C. Bogle, or Jack Bogle, for his friends. And you are his friends. He's the founder of Vanguard. So he founded Vanguard around the same time, a bit earlier, as a company that creates index funds and that basically aim to provide as much return to the individual investors as possible. And this is a unicorn in the sense that the entire financial industry has always been focused on trying to make themselves as rich as possible. It's never been how do we serve investors the best we can. It's always been how do we market to them in the best way we can so that they give us as much money as possible and we can charge them as much as we can, right? And they always had to sort of find the balance between charging a lot and still giving some results. John Bogle said, no way. We're going to put something together that is owned by the investor and works for the investors. It's going to be, it's like a corporation, no? It's there to serve the people who are investing. So to serve people like you and me. And I would say that if there's, for me, the top 2 people that I would recommend you investigate the life of, at least when it comes to investing in fulfillment and based on my experience, John C. Bogle is in the top 2, right? And I'll tell you about the other person that's in my top 2 later in this presentation. So it is developed by investor for investors. Index investing serves individuals like you and me. It doesn't serve the industry. And from there, basically grew a community that's now known as the Bogleheads. And I recommend you go and check this website, the Bogleheads, bogleheads.org. It's the community in the US, which is the most famous for really fine-tuning this method and sharing it widely around. It's a nonprofit. It's there to help people like you and me invest better and get the returns we deserve. And finally, it's simple, effective, and practical. It's so powerful that even Warren Buffett, which is the world's most famous value investor, right? So it's someone who actually works hard to find deals, buy them, and then profit from that. He is also the strongest proponent of index investing. So for him, he says, a low-cost index fund is the most sensible equity investment for the great majority of investors. By periodically investing in an index fund, the know-nothing investor can actually outperform most investment professionals. He has decided that his fortune, after he passes, will be invested in index funds because he doesn't trust that other fund manager will actually be able to do better than that. Right? So this is how far this thing goes. Like the very best investor of all times puts in money there and recommends everyone do it, right? Now, some key characteristics of index investing. Again, no speculation. As you know, buy and hold for the long term. Maximum diversification. We talked about buying the entire market. Can be learned in just a few weeks, and it takes less than 15 minutes per month to invest. So now we talked about the evidence. I wanted to show you some, right? This is data from Dalbar 2020 quantitative analysis of investor behavior study. So this is a study that looks at what other markets doing, right? Equity markets, here we can see 8%, and how much money are the investors getting? And in this case, you can see about 4.2%. And why is there such a difference? So this is what this study looks at, and they look at the last 20 years of data, which is what we used in the very first example of this presentation. And so they ask, okay, what happened? Where did this money go? Right? Why is it gone? What is with the investors that actually makes them lose money? Now, the money goes to all the intermediaries, right? So the brokers, the financial advisors, just money lost because we were out of the market. So there's a lot of things that go basically into fees, and the other part goes into emotions and speculative behavior, which is what the entire financial industry wants you to do, right? Because that's how they make money, right? The financial industry makes money in two ways: by making you trade more so that you pay more transaction fees, and by making you believe that there's someone smarter that can actually predict the future so that you pay a lot of advisory fees, and by making you buy the newspaper and the media that provides information about these two things, because then you get a lot of advertisement, which is sponsored by the people who actually make money through fees, and by convincing you that you have to hire them for, in the end, a much lower performance than if you hadn't. So the whole industry is basically has a massive conflict of interest. Every time they make money, it's money that is taken from your pot and that doesn't have the chance to grow. Every time they take a decision thinking they know about the future, in the vast majority of cases, on average over the long term, these are decisions that actually reduces your own returns, right? So the solution, as you know, we minimize fees through index investing and removes emotion and speculation. We buy and we hold, right? We buy and we hold the entire market. It's a long-term game, because we know that trying to forecast what the markets are going to do in the short term, it's nearly impossible to do it consistently. And it can easily be shown to be based on luck, a lot of it on luck. Now, another study, which is really important, is called the SPIVA scorecard. And they run analysis on all the funds that are available for purchase and investment. And they say, all right, these funds, how do they compare to the market, to their own benchmark, right? And so they take those funds and they take the historical performance. They say, all right, in the past year, how many funds actually did better than their market, than what they are trying to track and what they're trying to beat? Less than a third of these funds actually managed to deliver value that they promised, which is to do better than whatever benchmark they do, right? After 5 years, less than 20%. After 15 years, just 10%. Over 50 years, not even 1% of those funds actually managed to perform and beat the market. So you guys are very young, most of you are between 21 and 23, and you'll be investing for decades. And I'm not saying just 10 years. You're going to be investing probably until you're 90 or 100. I'm hoping you guys can live to 100. So that's like 70, 80 years, right? You don't want to pick a strategy that has that has less than a % chance of actually performing. You want to pick a strategy that has 99% chance of performing well, right? And that is what index investing is, right? We completely outperform the vast majority of professional fund managers, and the longer the time horizon, the most effective the investment strategy becomes. And even for 1 year, it makes no sense. You have one chance out of 3 to pick a good fund manager, whereas if you invest in index funds, you already beat 2/3 of investment professionals. Now let's look at what this means from impact on someone's life, right? So I went and I checked the average savings rate for people in Belgium. Now, not everyone is able to save. About 2/3 of people living in Belgium can save money. And of those who save money, on average, they save 360 euros per month, right? So if you compound this over an entire life, an entire career, let's say 40 years, it's probably going to be longer by the time you guys get to 65. It's for sure 67 or 70. But let's, for the sake of argument, we use 40 years. If you put in the savings account, well, anyway, the contributions, as you add those contributions, if you put 360 per month, you get to about 180,000 euros at the end of 65 years. If you put this money in a savings account, because interest rates are so low, they're actually below inflation, you lose money. About 1/3 of the money you put in savings account will be lost over that period of time. Savings account are making you lose money. It's something a lot of people know already. This because of inflation. Now, if you do invest, using a fund with the traditional bank in Belgium, for example, this is what the average results are. And I'm saying average because some people will end up being far higher than that, and some people will be far lower than that, right? You could lose a lot of money. That is still true. But that would be reckless, based on reckless decision, most likely. You could also do well, right? Because the average is here. It means there's a lot of people doing above, and well, half would do better, half will do worse. Now, that's only doubling the money compared to savings account. Now, what if you were to invest in an index fund that buys the entire market? You buy and hold, you pay minimal fees, you don't speculate, you just stay in. Well, this is the sort of result you can expect, right? Because markets completely outperform any kind of fund manager. So instead of doubling your money, you'll be quadrupling. Basically, by investing in a bank or through a bank, they take 70% of your returns. So this is, the yellow line is what you deserve, right? Because you're the one who worked and you're the one who is investing. You're taking all the risks. You should get all the returns. The financial industry doesn't take any risk. I mean, not investment risk like you are. And they get 70% of your returns, right? When you are the one taking the risks. Obviously, they do work, but it's work that's not really useful. It's very ineffective. Now that translates into something like 270,000 euros for the average person in Belgium. And looking at it in a different way, you know where I'm going with this. Let's imagine that someone was aiming to get to a certain amount of money to be able to retire comfortably, right? And in this case, about 240,000 euros. The average investor would have to work until 65. Someone who knows what we're talking about today would save 13 years of life because it would get to that same objective 13 years earlier, right? So this knowledge here has the potential of saving you hundreds of thousands of euros, but also decades of freedom, right? Decades of opportunities, decades of time with your family, with your parents who might get older and you want to spend time with them. Maybe you don't want that right now, but there'll be a time where you'll realize they'll be gone at some point and you want to be there with them. With your kids, right? I don't think most of you don't have kids yet. But kids are an amazing part of my life. And I wish them to you, right? And you want to be there for them and you want to be there to enjoy that. Anyway, so this is why I do what I do, because I want people to take back control, to take back what they deserve, to be able to control their lives and make choices that makes them happy, right? Anyway, let's go back to index investing principles. We've covered some of these, but I wanted to summarize them in a single slide. You need solid foundations. So you guys, you get a job. Some of you already have jobs. You're already making some money. The key is not to go into debt, right? You want to know that you are spending less than you're earning. You are able to save. That's super important. And the best way to get the control of that, of your cash flow, is to track. So for me, strong foundations include tracking your expenses, comparing that to how much you're earning, and being able to put money aside without going into debt. Then there is 4 main principles. Well, we talked about them already, but I'll summarize them here. Invest for the long term. This is not about buying something that we think is going to go up and then selling because we think it's going to go down. This is a strategy that's not working. This is a strategy that's based on greed and fear. And the main enemy of the investor is himself and his emotions. So we try to take the emotions out of the equation. We invest for the long term. We buy and we hold. Like I'm repeating this 10 times at least, but it's because this is probably the most important aspect of all this, right? We buy and we hold. We diversify. So instead of buying one company stock or 5 company stocks in different companies that we think are going to do well, we just buy the entire market, right? And you could buy the entire American market or the world market. And you can do that very simply by buying one index ETF that covers all those markets, right? And then we diversify also across different asset classes. So we talked about stock investing. You can invest and basically buy a share of a company. That is what a stock is. Or you can also invest in what is called bonds, which are essentially loans that you are making to either companies or governments in exchange for the promise of an interest that is paid on a regular basis, right? Bonds are much safer, obviously, because they are a contract where you're just guaranteed a certain return unless there is a complete, like a big default, but it's fairly rare in modern economies. And you want to buy or invest in very safe bonds because they are the bedrock of your portfolio. They are what provides you with stability, right? And then you want to invest in stocks because that's what's going to provide you with returns. It brings a lot of risk, but because you're diversified, it's not as bad as buying individual stocks, and it will generate a really good return. Now, there is a big part of of learning how to invest is to determine your asset allocation. Asset allocation is simply determining what is the share of your portfolio, the percentage that will be in stocks, and the percentage that will be in something fixed income like bonds, right? And typically for young people, the advice is to go with more stocks, a lot more stocks, all the way to 100% in some cases. I like to say that you probably need to add a bit of bonds. A portfolio with 90% stocks and 10% bonds actually has chances of doing far better than, not far better, a bit better than 100% stocks. And it helps you get used to having bonds in your portfolio, and you have to learn how to rebalance. And you get into the habits of having a portfolio that's balanced, that you can then gradually adjust as your personal situation changes with time, typically. Now, the next one is keeping costs low. One of the key reasons why a lot of investors just do so bad is because of costs. And so we invest through index funds because they give us diversification and they give us low cost access to the entire world market. Another element of cost is taxes. So because we live in Belgium, taxes here are different than they are in other countries. And so when we build our portfolio, we need to be wary of taxes. We need to understand how they work. And then we can then select, component of our portfolio that are optimized for that as well. And finally, keep it simple. As I said, the main enemy of the investor is the investor himself. If your investment approach is complicated, then there's more room for error. There's more room for doubt. And when you're investing for the long term, you want to minimize all the reasons why you would doubt. The key is to create a plan that's going to work for the long term, and so that you can stick to it, right? So keeping it simple is the way of holding your investment portfolio for the long term. As much as you can, try to invest in an automated way, because the less you have to think about it and the more things do just work on their own, the better you'll do. There are several studies that show that the best investors, the investors that get the best performance, there's two kinds. I mean, no, let's look at it this way, in the different way. There's been several studies that looked at what are the categories of investors that do the best. And in several studies, the top category was people who were dead because they basically were not doing anything, and people who had lost the password to their investment accounts. So basically, the people who do the least were the people who were making the most money. And that is why you want to automate, and that is why you want to invest for the long term and not touch anything once you have set your plans in motion. And finally, once you have a system that works on its own, then you can just relax, forget about money, know that you have a system you can trust, and then focus on what really matters in life. Hopefully build a life you love. We're going to do one more slide and then we'll take a break for questions. How to invest in index funds. First, you need to learn the basics. And we've covered a lot of that today, but there's a lot of technical aspects to investing that takes a bit of time. As I said, I think it takes a few weeks. So take the time to learn. You can either learn through, well, first of all, join the community, because there's a lot of resources, right? And I would say in terms of resources, you have some very good books. You have some videos online. If you look up index investing, I have YouTube videos that really go into much more details into the four principles that we discussed earlier. What else? You can join a course. I'm developing a course to help people learn how to invest. I don't know if there are that many other ways. You can work with someone who is already investing. So if you have a friend who really understands how to invest passively in index funds, then that person can help you. The community can help you, right? So if you have questions, you can ask in the Facebook group or on Reddit or on some of the investment forums, and you get really good answers. I would say be careful, because you can get answers from people who don't have very much experience, but are convinced of certain things. So it might there's not always all the wisdom you want behind the answers. Sometimes these are answers that are just repeated, and so people just repeat them without doing all the research behind. But I would say learning is the key. once you have understood the basics, then you develop your personal investment plan. This is the most important document that you will need for your investment life. It will have in there everything you need, right? So your financial goals should be there, your investment philosophy, which we talked about today a lot, the broker you want to use, the currency you want to invest in, typically euro for you guys, your asset allocation, which is one of the key characteristics that will determine what performance you will have and the amount of risk you're taking, and so the likelihood of holding through a stock market crash. You will have the specific ETFs. You will write what's your rebalancing strategy, what's your contribution strategy. You will write how you handle taxes, and then you will decide on when you do reviews and under what conditions you actually make changes. So the personal investment plan basically is your rule book, and you need to take some time to write it down and then print it, put it on the wall, because the key is to invest for the long term. So you want to be able to remember the decisions you made and why you made them, because in 6 months or a few years, you come back to your portfolio and maybe you sort of forgot the whole thinking process that led you to making the decisions you made. You want to have this somewhere that's documented and easy to find, because you need to protect from your own emotions and not having something that's really written down. It basically opens the gate to more problems. Then you open a brokerage account, and I saw a question on brokerage accounts. We're going to talk about that. You select the ETFs that you want to have on your in your portfolio, and then the key is to stay the course and benefit from long-term growth. If the market goes down, you should be happy, because it means you can buy more of the same stuff for a cheaper price. And since you're investing for the long term, you actually should be hoping for a market crash now, as long as you get a job, right? As long as you get a job and you can keep your job, then you should be hoping for a market crash. From a personal perspective, despite all of the damage it does in society, for you as an investor, it's actually good news. And then as always, you automate and you focus on what really matters. So as I said, 3 to 6 months alone. I mean, it took me 2 years because back then there was nothing. And then a few more years to really refine the way of investing. But I think if you have the right guidance, then 6 to 8 weeks, you can do it. Actually, maintaining this takes very little time, as I said, less than 15 minutes a month. And I would say 15 minutes is if you include a lot of different things. But the actual doing of what you need to do, it's just a couple minutes. What about taxes? Well, yeah, Belgium is known for several things. It's known for this little guy, is known for these delicious things, and is known for taxes. It's known for taxes because it's one of the highest income taxes we have in the world. But it's also known, actually no, it's not very well known for the fact that it has no taxes on stock capital gains. So there's no tax on investment profits. And this is a very rare thing. In most countries, there's a tax up to 30%. In Belgium, there isn't such thing, which means actually Belgium is one of the very best countries to invest in the stock market in the way that I am sharing with you today. And I did say that I was going to take questions at the end of the previous slide. So let's go back and let's see if you guys have questions. Chris, you want to help me out with this?
Sure.
Cool. I see a question on, like, I'm coming back to the question from Stan. And then we have question from Maxime, Simon. Simon is just, yeah. And then Stan again, yeah. So, right, has Corona affected my passive income? No. My investment is for the long term. So when there's a market crash, such as what happened in March, it's not even a crash, it was a little correction. It doesn't change anything to my strategy because I invest, with a time horizon of 40, 50 years. So no changes there and no effect. Although it did make us, a little worried because we do rely on our investment portfolio. We're not like you guys who actually would benefit from a downturn. For us, it really hurts us. But our portfolio is built so that it can sustain any kind of situation. And in the long term, we can continue withdrawing the same amount. What platform do you use to buy index trackers? In Belgium, there's 5 main platforms. Somebody mentioned DeGiro. That is the cheapest one. Yes, indeed. Be careful. Cost is not the only characteristics you should use for decision, right? Cost is only one of them. So DeGiro, Bolero, Bing Bank, key trade and links. Maybe I can type them. So we have Bolero, Bink, Bank, key trade, the Giro, links. These are the 5 main ones that the community speaks about. There are more, but these are the ones that the community is most familiar with. Which books are good for beginner? In terms of books, there's nothing on investing in index funds for Belgium. I do plan on writing a book like that, but will take a while. I would say for the investment philosophy, The Simple Path to Wealth is an excellent book. I have it upstairs. This is by J.L. Collins. It's a great book. Like, I would recommend everyone just start with this, right? The Simple Path to Wealth by J.L. Collins. You can even go to, you can check his YouTube talk, right? So if you go on YouTube, The Simple Path to Wealth, like that is an excellent place to start to get, like, it's basically, he's going to repeat what I'm saying here today, but the guy is 70 years more than, anyway, he's 40 years older than me. So more wisdom. And he has a different way of presenting things, but super powerful. Other places to learn from, I would say the Bogleheads, investment philosophy. If you
for you, the Bogleheads. Yeah.
Like, this is super important. Thank you for posting that. Yes. So there is a page for Belgium, which has a lot of details on taxes and what are the good ETFs. I don't know if they cover brokerage accounts, but a lot of really good information. This can be a little overwhelming. I would say start with the philosophy, make sure you understand that well, and then go into the more practical stuff. But this link is really good from Christia. What other books? I would say I like Quit Like a Millionaire by my friends Christian Bryce from Millennium Revolution. Like that. I also like Expat, Millionaire Expat by Andrew Alham. But that's because I was an expat, but it's still very relevant for people in Belgium. Because the way of investing as an expat is very similar to the way of investing in Belgium. The only thing we have to be careful about are taxes, which is very specific, and there's no book on that for Belgium at the moment. But for sure, books will come. I plan on writing one, and there are other people in the community who probably will do as well. And so books will come, but it will probably take another year or two. These are great places to go. Obviously, I will share this later, but the community, Financial Independence Belgium on Facebook or on Meetup, these are great places to learn the basics as well. All right, let's go back to the questions. What other questions do we have? How can index investing give you a monthly passive income when you invest in the long term? Good questions. I'm going to answer this later, yeah, if that's okay, because it's part of the presentation. Would you start with a bigger amount of money at once, or beginning with every month a smaller amount and money and keep buying on a monthly basis? The best time to invest when investing for the long term is yesterday. No, the best time to invest is as soon as possible, because you're investing for the long term, and on average, stock markets go up. So the earlier you do, the higher the chances you're going to do well. Now, yes, on average it goes up, but it goes down and it goes up on a regular basis. And it could go down as soon as you put the money in. It could also go up. What you're going to remember and what's going to hurt most is if it goes down. If it goes up, you'll be happy. But yeah, we have a bias, is that we feel more pain than we feel pleasure when we lose something, as opposed to if we were to gain the same thing. No? And there's a lot of studies that prove this. So if you want to manage your own emotions, if you have a large sum and it's a large part of your net worth, of your entire wealth, right? If all you have is this money, then you don't want to go all in at once, because that's too much, right? It represents everything you've saved from an emotional perspective. And so in that case, you want to split it over 2, 3, or 4 investments over several months, but not longer, I would say, than 6 months. You want to go into the markets as soon as you can, because you don't know the future, but you do know that on average it goes up. And if you have a large sum, start with a small sum. Something that is, big enough that you will be careful, but small enough that if you lose it, it's still okay, because you've kept, the majority aside. So that just for you to get used to the process, because the process can be complex a bit at the beginning. You have to gain trust in the system gradually. Yeah. Now, if all the money you have to invest is only a small fraction, say you own a couple of apartments, whatever reason, and then you have €1,000, then just go in. €1,000 will be nothing compared to what you have, and so that's fine. I hope this answers your question. Index funds with or without dividends? That's a very good question. It's quite technical, but in Belgium, there is a tax on dividend payments that come to your account, but there are no taxes on capital gains. So we like to invest in accumulating ETFs, which basically they reinvest the dividends. So the dividends don't come to your account, which means there's no income. You don't get taxed on that. They are reinvested right away, and they buy more shares for you right away, so you don't get taxed on that. And so from a tax perspective, it's optimized. It's more optimized to buy accumulating ETFs. More questions. What literature do you recommend on index investing, which will give you more technical information? I think the Boggerheads website is the best place to go. So start with the philosophy, read on how to invest from Belgium, but then go and dig deeper into how index funds are built and how index ETFs work and how the whole tax system works. There, obviously, it's like a wiki. It's like a wiki page, or it's a wiki website, and it's got a lot of information. So if you follow the links according to what you're interested in, then you will find a lot. And then they also point out to a lot of resources that are really interesting. But I would say if you want a more easy read, then JL Collins' website is good. Millennial Revolution website is good. I still think Boggerheads is like the core, the key source of information. Which ETF do you believe should be in every portfolio? I invest in the entire world, so I don't have a particular preference as long as you have a wide diversification. For Belgium, there are a few ETFs that are quite well optimized for taxes and everything. There's a couple for Vanguard and a couple for iShares. I would say go for world ETFs, and that is probably the best piece of advice. Low cost world ETFs, widely diversified. That is my best advice. I will not recommend anything in particular because I don't give financial advice. But with that, you should be able to find them, and I discussed a lot in the community. How much time do you spend for managing a portfolio? I've stopped working 2 years ago, and since then I've looked at my portfolio 4 times, maybe half hour, 4 times an hour maybe. So every 6 months, me and my wife would just sit down, we look at our spendings, we look at our accounts, we put it all in the spreadsheet, we do the math, we rebalance, and we withdraw. And so the whole thing takes about an hour. So about 2 hours a year. I think that's sort of what I spend nowadays on making my money work for me. My money works a lot more than I do. Yeah, because it's optimized. When you are starting, you will probably spend a bit more time at first because you will want to make sure you understand everything, and that's important. So this is the learning part. Once you have a plan in place and you're fairly confident with your strategy, then it shouldn't take you more than 10-15 minutes a month, including almost everything. No, especially if you have automated a lot of the different steps. Yeah, good point by Hust. If you're looking for specific ETFs, the main ones are documented on the link that he shared. I think there are some new ones coming from Vanguard. I don't know if they've been already added in the wiki, but there are some good options with Vanguard today that kind of match what iShare has been doing for a while. And then something that is not shared there are all the sustainable ETFs. So there's obviously sustainable investing, impact investing is something that's becoming more and more popular. My own portfolio is made out of ESG, which stand for environmental, social, and governance ETFs. So they've applied a filter, removed all of the harmful companies according to specific criteria. So that's my way of investing. I would definitely recommend, if you're interested in having your money work for a better world, then take a look at ESG, ethical or sustainable ETFs. Yeah. If you invest in the world ETF, do you need to check valuta changes? No, there's nothing to do. You just buy and hold. There's nothing to check. You only have to do your due diligence at the beginning when you pick an ETF to make sure that it's fiscally optimized. It's low cost. It's widely diversified. It's actually physical replication. So there's a bunch of things you need to look at. once it's there, there's nothing to do because you buy the entire world. And so you get the market returns. You get the very best performance you could dream of compared to everyone else on average. How are we doing on time, Chris? It's 9:15.
I think let's continue. We can build.
Yeah, I'm at
questions up.
24. I've got another 20 slides. So, and a lot of, there's also this practical tool that I've invited everyone to download. We're going to get there fast so that we can do that. Yeah. So taxes, we looked at it. That's fine. Let's look at financial independence. What I call the simple path to financial independence. So start by saving money. Start by saving money, which means you have to spend less than you earn. You reduce expenses the first step because it's the easiest, and you make sure you save for emergencies. This is the emergency fund. You want to have 3 to 6 months of money set aside in case something bad happens. 3 to 6 months is the global, the usual recommendation in Belgium. Like if you are eligible for chômage, for example, and one of the big risks is that you lose your job, then maybe you don't need as much because Social Security will help you. But this is a very personal decision. So think about that. Work on increasing your income. That's important. Maybe you have enough to start investing right away, but at some point you have to think about how you're going to earn more because that's going to make a big difference in your path to financial independence. When you have savings extra and you've built your emergency fund and you've taken care of all the expensive debt, then you want to invest efficiently, which is index investing, which we talked about. After some time, it will start accumulating. At some point, you'll get to a certain amount. And in this case, we use the 4% rule, which I'm going to speak about in a second. And you get to a certain amount that basically allow you to be financially independent because your portfolio will generate income or will generate passive income or generate value that is above what you need to live, right? So that is when you get to the point of not having to work for money ever again. And there's a little formula here that I that I developed. If you like formulas, you can take a picture and try to plot it. It'll give you an idea of how soon you can retire depending on your savings rate. How much do you need? So this is the question of the 4% rule of thumb. So there's obviously a lot of people who do research for retirement planning because that's a problem that everybody has. And they were trying to see what is the maximum amount people can withdraw from a certain portfolio so that portfolio lasts a long time. And so this specific study, the key study is called the Trinity study. That's a surname, but a nickname for it. But basically the studies typically look at all of the historical data of the stock market. They build a portfolio that's balanced. So in this case, it's 60% equity, 40% bonds. And then they say, all right, what happens? How much do we need to withdraw from that portfolio so that it gets to zero after 30 years, right? And then they test this over all of these periods of data, all the 30-year periods that they have over 100 and I think in this case 140 years of data, right? So the data starts in 1871 and it goes all the way to 2011. So the last period starts in 1981 plus 30 years, that's 2011, right? And what they do is they say, okay, for each of these 30-year period, how much can I withdraw so that it gets to zero at the end, but not under zero? So for 1971, you could withdraw 9% a year. And at the end of the 30 years, so in 1901, you would have reached zero on your portfolio. By withdrawing 9%, that means it doesn't mean that the portfolio did 9% on average, but it did enough to be able to sustain a 9% withdrawal rate, right? So the portfolio did less than that, but if you withdraw 9%, you get to zero and not below. Now, the average withdrawal rate was about 6.4, 6.5, but the worst, so the lowest and the safest withdrawal rate was about 4%. So this is where this whole 4% rule of thumb came from. This one study that showed that if you withdraw 4% of your portfolio, you have very high chances of your portfolio lasting the full 30 years, right? But in most cases, your portfolio will not go under, you will not lose capital. The portfolio will actually continue to grow. Why? Because you're withdrawing less than what the portfolio grows on average. So this rule of thumb is based on the worst case scenario, which is unlikely to happen because the worst case scenario in this case happened once in 140 years. And so the chances of that happening to you, fairly low. Now, it's not perfect, and there's a bunch of things that doesn't take into account. For example, for people who want to have their portfolio last longer, this study is not enough, right? And for people who want a different asset allocation, the study is not enough either. Now, there's a great website of an analyst, an investment professional that does a lot of work for people who want to retire early, right? It's called Early Retirement Now, and this guy called Ernst, no, can't remember his name. Anyway, you can see on the website. He did a very deep study, and he went further. Instead of taking these data 30-year period by every year, he did this on a monthly basis. So he has far more periods, and he did this for a lot of different variations. So different sizes of different asset allocation. So 100% stocks, 75% stocks, 50% stocks. And every time that we say, if we say 75% stocks, it means the difference, so 25% will go into bonds, right? And then he looked at what is the rate of success of a specific withdrawal rate. So if we withdraw 4%, then for a 100% stocks portfolio, there's a 97% chance that this portfolio will last 30 years, right? Now, if we withdraw 5%, we withdraw too much, there's only 8 out of 10 of these portfolios that survive. There's only 80% chance of survival. Now, if we withdraw only 3% and we're investing 100% stocks for 30 years, then it will work in every single situation, at least historically, right? So this is what we know based on the data. And so based on that, and especially for people who retire earlier, which I think a lot of you can, because you're learning this at the time that gives you a lot of advantage. There's a good chance that you will want your portfolio to last for 50 or 60 years because you'll be retiring before 50. In most cases, I would say, because you're here today. You're probably already saving 15 to 20 years of freedom and of your life by just being here today. And if you take action after this, then it's quite likely. But so at that point, 4% rule doesn't work because it's a 90% chance of success. So when you actually quit your job and you want full security, you're not really happy with that 90% chance of success. You want to get closer to 100. So a lot of people in the community today use 3.25 or 3.5% on portfolios that are, typically around 80-20 or 70-30. So more into this area. And they aim for something that's closer to 100%. So typically the withdrawal will be 3.25 or 3.5%, and portfolios that last 50 to 60 years will be more around 75-25 in terms of asset allocation. Right. So these are details, and like if you don't understand this, it's fine. The key is to understand that there is a simple way of doing math that will help you determine whether your portfolio, how much you can withdraw on an annual basis, and your portfolio will last for a long time. Now, don't forget, this is without counting on the national pension, right? Now, you guys are very young. You can choose to either say, I think I'm going to have a pension, or you can choose to say, I don't know if there will be a pension. I'd rather be ready on my own, right? So that's for you to decide. Now, how does this rule function? Let's imagine that you spend 40,000 euros on an annual basis. Now, maybe that's not what you spend today, but maybe that's sort of the budget you want to have once you have a family and you want to have a very comfortable life with vacations and all of these things. That you're investing in a balanced portfolio of index funds, Boglehead style, and you are going to use the 4% rule to make the estimate. So how do you actually determine how much you need when you want to spend 40,000 a year? This is a question for the chat. So if you could type in the chat how big your portfolio needs to be so that you can withdraw 40,000 euros per year using the 4% rule of thumb. And Hust is not allowed to answer. 1 million, I see. All right. Or what are other people thinking? 400,000. So you withdraw 40%. Sorry, you withdraw 4%, and that gives you 40,000 euros. Okay, guys, give me more answers. 850. 1 million. 1 million. 1 million. 1 million. All right, I think there is a consensus. Yes, so it is 1 million. And here's the math. it can sound a bit complicated, but yeah, 40,000 is basically 4% of a million, right? So the 4% rule says that you can withdraw 4% on an annual basis. So 40,000 is 4% of a million. And to be able to calculate that, you either divide by 4% or you multiply by 25 and you get to a million. Yes, so well done, everyone. Almost everyone. Now, what if you need 100,000 euros per year? How much would you need in your portfolio? All right, let's do it again. Let's see if you're quick with math. You need 100,000 per year. How big needs to be your portfolio?
5 mils.
2.5. Yeah. All right, guys. Okay. I know you're in business or law, so I think you know math, right? 2.5 million. Pretty luxurious life. How much do you need? Whoop, too fast. Okay, too late. If you need 12,000 a year, so if you can live on 1,000 euro a month, you only need 300,000 euros, right? 1,000 euro a month. Can you live on that? Yes, no? Quick answer. No? I mean, you do now, right? I mean, some of you. Yeah. All right. Rather not. I agree. Yeah. You don't have to. Maybe less. All right. So what about in other places? Like not in Belgium, but could you live on 1,000 euros somewhere else? Yes, no? Yes. All right. Yes is the answer. 1,000 euros is a happy life in most countries. All right. Not maybe expensive places like Brussels, London, or New York or Paris, but in a lot of countries, people live on less than 1,000 euros, right? And like even nearby, right? You go to Germany in Bremen, you go to Italy in Genoa, which is a beautiful city. You go to Poland, Krakow, which is a beautiful city. Very, very good quality of life. Things are cheap. That's just what it is. We live in a fairly expensive place, but you don't have to go very far. Even Finland, but I think that's kind of in a very cold place, so that's why it's cheap. But you can live very happy with 1,000 euros in a lot of places. And this is data that comes from nomadlist.com. I recommend you look at it if you're interested in nomadic lifestyle, digital nomad, or financial independence. Nomadlist.com. Very inspirational place, especially if you plan on retiring early and you want to see how cheap you can live off. Anyway, South America, Southeast Asia, beautiful places, even in Nantes in France. So yeah. So yes, you can. So 300,000 euros, that is not as scary as 2.5 million, right? So it's doable. Now your turn, right? I did share this link with you before. I'd like to share it again with you. If you could go get this, I will put it again in the chat. Calc. If you copy paste this in your browser, you can download it. I invite you guys to do that because we're gonna work with this tool and you can do some math for yourself. Yes, you probably don't have an income like most working people, but you can think of some of the questions. How is that going? Did you guys actually already get it? Because it should, so you get to a page where you can put your email address, you can decide to subscribe or not, and then you receive the tool in your inbox. And then from there you can open it and it will look like this. I'm gonna share my screen soon. FI calculator, here it is. Right, I'm gonna share my screen. I need to stop sharing first. Yeah, I'm gonna share my screen. Right. So, Chris, can you see my screen? I think you can, right?
Yes.
Right. So you will get something like this in your inbox. You will get the link to this very same spreadsheet. So when I make changes, you will see the changes happening on your side too. I'm gonna change the date here, 20th of November. That's the last time I gave a presentation with this thing. I'm gonna change to 26 because that's today, right? And so normally you will see 26th of November on your spreadsheet. Now you can't make an edit. You cannot make changes directly in this spreadsheet. What you're gonna have to do is you go to File and you make a copy to your own Google Drive, or you download here, right? You can download as an Excel file or something else. Excel is good typically. Right, so this is how you get it. Make a copy or download, and then you can change, and this tool is becoming yours basically. So the top part is where you write all the input and assumptions, right? Especially all the yellow things here. You don't have to change everything. There's a few that you don't really need to play with. But you can definitely change some of the amounts because that is what you have the most control over. The percentages, you don't really have very much control over that. There are assumptions. You can't change what the markets will do. We take the assumption it will be 7.5%. Inflation, we take the assumption is 2.5% on average over the long term. There's nothing you can do about that. These are just assumptions. You can change them if you want to test different assumptions, but that's not something you can actually act on, right? What you can act on is how much you have to invest, right? And some of you will have maybe, I don't know, 5,000 because you've been able to save as students. But maybe most of you will probably have zero, right? So now how much can you actually save once you start working, once you start making an income and invest? Let's say you can put aside 500 a month, right? And you want to be able to live on, say, 2,500. So these are the key ones. I'm even going to change the color because it's really important that these are the things you can really play on or work with, right? Now there's a theoretical safe withdrawal rate. There's an investing cost, which if you do invest using index investing, like we talked about today, then about 0.3, it's not bad because it includes the total expense ratio and then some of the transaction costs, etc. You can estimate it to be 0.3. And then the theoretical safe withdrawal rate, which is, we use 4%. We could use 3.25 or 3.5 as well if you want. For the sake of the exercise, we use 4. But you have to deduct investment costs from that as well. So here, again, we take 0.3%. It's not super accurate. It should be probably a little less. Should be, yeah, anyway, but it's still a good estimate. So how is that going with everyone? Do you guys have access to the spreadsheet? Did you manage to make your own copy? Can you tell me in the chat? Can't see anything. Where's the chat? All right, there it is. Yes. All right, so it's working for everyone, yeah? I hope you also subscribe, so then you can join the future meetups we have on this topic and some of the events that we're organizing. But you can always back and subscribe if you forgot, no problem. Right. So here you can put your own numbers, right? Let's look at the screen I'm sharing for now, and then you'll do a bit of number on your side, right? So 0%. Sorry. You start with 0, you save 500. So let's say you have a salary of 3,000 and you spend 2,500, you can save 500, right? Since you live on 2,500, you can make an estimate that in the future you will live on 2,500. This is an easy way of looking at this. So what do the numbers look like when you do that? Well, inflation plays a role. Oh, I did leave this here. We don't even need that. Anyway, so inflation plays a role. And if you need 2,500 euros today, it means that in 43 years, which is your time to financial independence, you will need 7,334, which means that you will need a fund value of 2.3 million euros, right? And that is you reaching financial independence in 2064. So that's in almost 44 years. Now, that is the traditional way of doing things. You save, 20% of what you earn or something like that, 15, 20%. Now, the key is to do better than that. Right. So this tool is not so much to tell you, oh, you only have to work 12.32 years and then UFI, or 43.852 years. And then, no, this is a tool for you to have a first idea of what it means to invest and how playing with different parameters and acting on some of the levers you have, you can make a difference, right? So say you do start with a 3,000 euro contract. I think it's quite well paid that for a complete beginner, no? But let's say this is, you're going to be there in a couple of years or 3 years or something, depending on, obviously, so many things. It's just an assumption. Now, let's imagine that instead of spending 2,500, you manage to save, and we're not going to do very much. We are, with these current assumptions, we need 43 years, right? Let's say you manage to live on 2,400 euros per month. That means you're actually saving 100 more, and you can invest that. Right? So we only changed numbers by 100 euro per month. What's the difference? We saved 5 years from 44.8. No, it was 43.8. So we actually saved 4 years, right? So from 43 years, 8 months, we went to 39 years and 6 months. That's already better than your normal career or your normal time to financial independence or pension, because there's a good chance, it'll be until 70 anyway. 100 euros bought you 4 years of freedom. Now, when you do spend those 100 euros, or when you think of spending those 100 euros, just think about what is more important to you. Those 100 euros a month, right? So that could be some subscription that you maybe almost never use, or I don't know, some habits you have of spending on specific things that are just a little bit more expensive than the rest, or whatever it is. What's more important? This extra little bit of thing that you may not even be using, or 4 years of your life? Like that is one way of thinking about it. Now, I don't want you to become completely obsessed with this question, right? But it's an easy way of valuing how much spending changes in your life, right? How much a small difference in spending and saving actually makes in your life, right? So when you save 100 euro and you invest that difference, it's 4 years of your life. Like 4 years, it's it's a lot of time. It's a lot of time. Now let's go further, right? Let's say you actually manage to save even more than that. So you go to 2,000, right? You save 500 euros than you used to, and so you can invest 1,000. How long do you need until financial independence? 27 years. You just bought an entire decade. Okay, let's continue. Let's say you manage to save 1,500. You're still earning 3,000, and you're investing 1,500. How long do you need? 17 years. Like 17 years. So today you guys are 22, 23. That means at 40, you're done. Right? I mean, you're done. Life, like a second life starts, because it's really just the beginning of a different adventure. And a very exciting one. But what if you can be super smart with your money? Right? And you live on 1,000 and you actually invest 2,000. 10 years. Like at 32, you could do it before me, right? I retired at 33. But this is obviously assuming you're able to save massive amounts, right? Now, the question is, all right, how do I earn more, right? Because, okay, so reducing is one way, but you don't want to go too far because you don't want to be miserable. Let's say you can live on 1,500, which I think a single person can in Belgium very easily. Very easily. Being creative on some aspects, you can have a very happy life with that. And instead of making 3,000, you find a job in a specific industry that maybe people don't want to do, right? I don't know, you go work on rigs or boats, or you go work abroad as a consultant that travels all around the world, or you take on, some of the hardest and most difficult jobs. You take the biggest and most difficult clients that your company has, and you just keep bringing value because you deal with the most difficult problems. And you make 5,000 net for whatever reason, right? Sorry, you don't make 5,000 net. You make 5,000, so you can spend 3,000, you can save and invest 3,500. That's still 10 years, right? So it's powerful, but earning more and keeping your expenses fairly high takes a lot of effort compared to, say, you earn only 3,000, right? And you just be very, very smart with how you spend your money. And you still do that in 10 years, right? So it's worth working on both because they're both super powerful. But being smart with your spending is something you can do much faster, and that requires far less investment in your work, and it typically also comes with less stress. But these are things you have to play with. I would say, from personal experience, the best way to save money are these structural changes. And I did talk about housing, and I would say with housing, if you play it smart, there are ways for you to live without having to pay for housing, apart from living at your parents' home, right? Which you can do, right? But then I would recommend you actually pay for expenses and you pay some rent, because it has value and they like it, especially having a job. But you can also be smart and find ways to rent a bigger place and sublet some places, get the approval of the owner, of the landlord, for you to manage a bigger place. And basically, with all other people's rent, you pay your own rent. And the service that you provide the landlord is to manage everyone's things. No, that way you could be living rent free. And in that sense, you can easily live on less than €1,000 a month if rent is paid like that, right? There are other creative ways of doing this. I'll invite you to explore, because we can't do that in this session. Right. Have you had the chance of doing some math on your side? Can you tell me in the chat what sort of numbers you've got? Like, these are just first numbers, no? But have you tried different things, and like, what do you get? Is it 50 years? Is it more like 20 years? 10 years? 55 years? Right? Yeah, 30, right? What else? Like, who has got some number? Like, all of these are just completely assumptions and imaginary stuff, right? Because I don't think many of you have jobs right now, but yes, Kirian, this is good. If you start with 100,000 euro more compared to zero, it only changes by a few years, not very much. What really makes a big difference is the monthly contribution in and out. Yeah, very true. So who has got some numbers? Obviously, it all depends on the assumptions, but you've played with assumptions. What kind of numbers you get? That's it. We have only 4 of you guys. 27 years. Awesome. Right. So there's still only 4 of you guys. Okay, cool. No problem. 43. 17. Yo, very well. Very good. I see some people are really ambitious. That's good. But look, all of those numbers are great. And, for those of you who have like 50 years or 40 something, and it looks like it's a big number, there's still a chance that pensions will still be around by the time you get to that, right? And so all you have to do is not to pay for the rest of your life using the 4% rule, but just to bridge the gap between when you want to start working and when your pension kicks in. Right? So if your timeline is like 20 years, it means you get to 40. No, wait. If the timeline is, say, 40 years, so from 25 to 65, the truth is you don't really have to go all the way to 65 because your pension will start at 70, for example. All you have to do is bridge this 5 years. So there's a good chance you'll be able to stop 5 or 10 years earlier because you will have the portfolio to maintain a good standard of living throughout those 15 years and then probably even, beef up your pension, right? So this is a way of thinking about all this stuff. Yes, it's true, but I do know teachers that make 5,000 euros. The trick is you have to kind of go out of your way, and teaching abroad, for example, is a way. Teaching very, very specific things. So obviously, I don't know your profile, but I would say be careful when you say my pay will never be, because that's a limitation you are deciding for yourself. It's not always true. But I do understand, right? So just don't limit yourself in this case, especially when you're talking about how much you could earn, because the truth is there's no real limit to it. And you will love the book Millionaire Expat because it's written by a teacher who became millionaire on a teacher's salary. So if he can do it, you can do it. He retired, I think it was 45, 44, I don't know, early 40s. And he's one of my good friends, and he's teaching people what I'm teaching here today too. So Millionaire Expat, or you can check Millionaire Teacher. Millionaire Teacher. His name is Andrew Hallam, and he's awesome. He's really awesome. Obviously, teachers are awesome in general, and he's just such a good teacher. He's just really awesome. Right, I'm gonna stop sharing this thing, and I'm going back to my presentation. We have a few more slides, but not very many. And then we'll be there. I mean, there's 10 slides, but we can go quite fast through the last ones. Right, I hope you like this. I hope it gives you some idea of, the power of index investing, how financial independence works. And I hope you see that it is doable, right? It's just a matter of getting the right numbers in to work for you and learning how to invest in an effective way. One thing we didn't do is playing with the investing cost. So this is the 0.3%. If you invest with a bank, you need to change that to 2.5% at least. And when you put that, and we should do it, and I invite you to do it, put 2.5% for investing costs and then see what changes happen. And it's just madness. Like the time to financial independence quadrupled. Like financial independence becomes impossible. If you invest with a bank, you just never retire. Why? Because the safe withdrawal rate becomes like 1.5% and the growth is completely wiped out and it plays against you twice, right? If you invest with a robo-advisor, which will be helping you invest in index funds, typically it would be about 1%, a bit more, 1.2, 1.3%. And that will also change your time to FI massively. But it's true, you will not have to learn. They'll do it for you. But it will cost you, years of work, or years of freedom. So this is the value of knowledge, right? If you don't learn what we talk about today, then you pay 2.5%. Like most people, you get average returns over the long term. And FI, maybe you'll be able to retire 3 years before everyone else. Maybe 5 because you saved a lot. But it will not be decades. So this little piece of information, what Hughes is bringing to you today, it's worth decades of your life. It's worth decades of freedom. So I hope you thank him a lot for that. Right. Now, some of you did come with very big numbers, right? And because, say, you're a teacher and you don't expect to be able to earn very much, and there's only so far you can go in reducing your expenses. So even after optimizing everything, it still takes you 20 years. Now, I would say that's the danger of financial independence. It's the danger of the financial independence community, fire community, is that a lot of people are really focused on that time where they can quit. And I think that's the wrong way of looking at it. What's important is not that you quit and go take a nap. The important is that you can make better decisions in your life. And you can make better decisions from the moment your financial security goes up. The moment you start taking control, you will have power. You will have power in negotiating with your employer, salary, for example, or he wants to send you to some crazy country where it's dangerous. You say, there's 2 ways I can do that. Either you pay me double or I don't do it. And you will be in a position where you can negotiate. Why? Because you don't depend on him paying you for you to pay your bills. You'll have savings, you'll have an emergency fund, and you might even have already investments working for you that can cover part of your expenses. And you'll be in a position of strength when you can make decisions based on things that are important to you, based on values and not always based on money. So as you progress, you become stronger. You'll learn in a few weeks or months how to invest. You'll get very good benefits for every step that you take forward, right? So more safety, right? Every time you have €1,000 more on your savings account or your investments, it's more power to you. More control, and controlling your expenses, knowing where you're going, having some kind of forecast, having an idea that at some point you'll be free, that gives you power, right? That gives you confidence. That gives you freedom and gives you options and opportunities. If someday you want to start a new business, and a lot of people can't start new businesses because they need their income to come, they have savings for 2 months and then that's it. They need their income. But if you want to start a business and you have 5 or 10 years of savings in the bank, you have all the time in the world to come up with a great idea and do something amazing. Now, I wouldn't recommend you quit your job to start a business. I would say start the business, and when it runs, quit your job, right? But still, you have the opportunity, you have time, and you have options. So I would say start now. Another way of joining the mailing list is to download the Beginner's Guide to Index Investing, which is available on my website, firebelgium.com. You can join the Facebook group where me and Hughes actually met. It's called Fire Belgium. You can find it on Facebook. We have meetups every Tuesday. They're very much fun. Tens and tens of people joining every week. We do live meetings when we can. This is the very last one before the lockdown. We went to have a beer in the center of Brussels. There's people all the way to the tables at the end there. It was fun. We'll do more of that when we can. It's rare to be able to speak about money and freedom with people. It's hard typically with friends and family. But with like-minded people, we learn a lot. Like at every single one of these meetings, I learned something really interesting. And for other people, these meetings have changed their lives already now. So I recommend you join. In December, I'm actually going to hold webinars to help people start investing. And I did tell you about the course that I'm building. I will be launching my course. It's a program that takes people from start to finish in 6 weeks. So if you don't know anything, then it's perfect for you to start. If you have any doubts, then join as well. 6 weeks later, you'll have everything in place, the investment plan, your brokerage account open, funded. You will have made the transactions, and I will guide you through each of the steps. You will have access to me for question and answers. You'll have access to community. You will have the templates, the tools, everything you need to be able to invest from end of February, everyone will be investing. Now, I realize that not all of you are in a position to do that, and so there's no rush. I would say for all of you who are students, I'll give you a discount. So my approach is that knowledge is power, and so I want to make it easier accessible to people who are students who can't really afford maybe a full price. So you have, you get the course at half price as long as you let me know that that you're a student, then you'll get the course half price, no problem. But yeah, so feel free to join to those. Connect with me on LinkedIn, on Facebook. What I'm gonna do now is maybe just share all these links with you in the chat so that you can just click them. And then we'll go back to the presentation. Where is it? Here we go. So I'm gonna do that here. Actually, you can't click them. I don't know why Zoom does this, but you can just copy paste if you want. Here. Right, here we go. And then I'm coming back to my presentation. Right, this one. Right, now we have 10 minutes. First, can I talk about how to build a life you love, or should we do more Q&A?
I don't see any more questions, so maybe just continue, and if there are follow-up
Let's do that.
questions,
So if any questions come up, guys, put it in the chat. And in 5 minutes, normally 10 max, when I finish this, we can do more Q&A. I can stay a bit longer, maybe another 15 minutes after 9 for those who you want. But yeah, in 10 minutes we'll be finished, and so you're free to go as well. So how to build the life you love. Now, I just spent an hour and 50 minutes talking to you about how to invest for freedom and how to save and invest and become free in 20, 30, 50, some of you 17 years. But there's another approach to all this, which is something that I wish I knew. Actually, I wish I knew about both of these things when I was your age. And I spoke to you about only this one. Chase money, endure a tough career, take really hard jobs, earn a lot, save a lot, invest and wait for freedom, hoping to enjoy life in a few decades. That is one approach. Obviously it sounds bad like this because I made it on purpose to sound bad. Hopefully you do enjoy life on the way, because the key is to find balance between saving and investing. We actually talk a lot about how to find a balance between, investing for financial freedom and then enjoying life today, right? This is a very big topic in the community. But I would also say, think about finding fulfillment through work, right? So don't work just for money. Ask the right questions. For me, which I asked you at the very beginning, what's really important to me? What gives me meaning, right? And especially from a career perspective, what will give you meaning? What would make you go to work motivated and happy to go to work? And obviously one of you is a teacher. I think that's already a very strong motivation, but a lot of you are still to decide where you're going to go. Some of you may already have jobs for next year. But I would say, think about what will make you fulfilled in life today or in the near future. And I would say, consider that as a real good path too, because we need to live in the present. Someone talked about enjoying the present at the very beginning. And that's really important. Yes, I think investing for the future is super important, but it should never come at the cost of being fully present and enjoying the present and being there for your loved ones and your family. So find the balance. Some sacrifices, yes, but it shouldn't be so hard that you're miserable for 20 years. So I like to think about life, especially when you're at the beginning of your career and you still have choices. Think about what will give you meaning at work. And there's this concept of ikigai, which some of you might have heard already. It's a Japanese concept that combines two words. One is the meaning of life, one means life and alive. Then one means value, reward, being fruitful, or something worth doing. And it can be translated as a reason for living or a reason for being. It's something that in French would be raison d'être. Something that makes life worth living. A meaning for life, or a reason to get up in the morning. And I think, at your age, I wouldn't make financial independence your key priority. If I were in your shoes, I would say this is important. Yeah, let's figure it out. Let's learn how to invest. Yes. But I would say, think about this more. And I know it's really hard. and I know it's just like it's like this is a $1 million question. Like, what will make you happy? No, what will bring you fulfillment? And I've done that work myself, partly because at some point I knew I was going to stop working. So I thought, all right, where am I going to go? Like, how am I going to decide what to do in my life? No, what is going to be my reason to get up in the morning? Yes, my son and my wife and my parents, these are some reasons. But what else, right? And the reason I'm here today is because I found some reason. Like, I want to serve. I want to help people, right? The reason I'm doing this talk here, I don't have to, right? I don't have to. I don't need to make money. I don't have to create a course and then make it a business. And I don't have to, just drive this community and teach. I don't have to. I don't need to. But it gives me purpose, right? I'm serving, I'm helping, and I'm making a positive impact. So that is me. That is me, right? But so Ikigai is kind of thinking about this question. And I would say, I think this is more important than learning how to invest. But obviously I would say do both. But don't forget to do this one. It's more difficult, I think, but it's really, really worth it. Now I'm going to give you a few hints and ways of how I look at this. Ikigai is also often represented by this diagram. We have like 4 circles, right? The circle on the right is figuring out what the world needs. The circle on the top is figuring out what you love to do. The one on the left is what you're good at. Now, you're not born good at anything, but you can become good at some things. And then the bottom one is what you can be paid for, right? And then in the intersection, I don't know if you can see my mouse, I hope you can. In the intersection, for example, of what you love and what the world needs, then you can see that is what people call the mission, no? And because it's what you love doing and it's what the love needs, that the world needs. So there's this passion behind this. There's something that's driving. Now, what you love and what you're good at, that can be called the passion. Sorry, I just mixed up 2 things. And then if you combine those, it's like delight and fullness, but no wealth, right? And you can do this more or less with all the other ones, right? If you're good at something and you can be paid for it, then it becomes a profession in many cases. If you can be paid for it and it helps the world, then it can be a vocation, but maybe you don't really like it or you're not very good at it. Anyway, Ikigai is kind of the combination of all this. It's a reason for being. It's something that helps the world in a certain way. You love doing, you're good at it, and you can be paid for. So finding this is pretty good for a career because it gives you meaning in addition to just being paid, right? So I would encourage to think about these 4 circles and simply list the stuff you like in each of these. What the world needs, what are the problems that you're passionate about solving? What you love, like what are the things that make you happy? Just list them up, right? It could be just smiling and spending time with friends and family. It could be wine. It could be like whatever you love, right? It could be sports car. I don't know, like the thing that make you happy. What you're good at. That the thing is, you guys, early 20s, you can become good at anything. So I would say, don't even think about this. You're probably already good at certain stuff, right? Because that's how you decide on your studies. But you have 40 years to become good at whatever you need to be good at. That's my way of looking at it. And what you can be paid for, this is very flexible because there's a lot of ways of getting paid for a lot of different things. Anyway, my way of looking at this very, very seriously now is to start by asking seriously, what does the world need? I would say, don't leave it to chance, because if you say, I'm just going to get the first job I can get, there's a good chance it will not be something that really makes a difference in the world. But if you say, I'm going to figure out what the world really needs, I'm going to figure out the best way that I have to make a difference with my work and my life, and then try to find a job in that thing, then that's going to be very fulfilling because you're going to have an impact. And when you have an impact, you feel good, and a lot of really good stuff happens to you. It's related to karma, but if you help others, then good stuff happens to you. Success comes, money comes. So I would say start by thinking about what the world really needs, and then become good at solving that problem, right? And as you become good, you will start loving it. Why? Because you're gonna be doing an impact, and you're gonna be becoming master in a specific type of work. You're gonna get the competence and the skill set. You're gonna find a mentor that helps you. You're gonna find people who have the same mission. You're gonna be surrounded by people who can push you forward, and you're gonna be supporting great projects, things that are bigger than yourself, right? And that could be climate change. It could be social justice. It could be helping things in your neighborhood. It can be fixing another problem. What does the world need? And go do that, because that's where you're gonna find most meaning. This is my personal perspective, right? You can see actually at the bottom of this page, it says impactivity.com. That's my other blog, where I share more of those type of things related to career, financial independence, philanthropy, etc., altruism. Now, obviously, financial independence helps a bit because it removes the entire circle from the bottom, right? So you remove the need to be paid, and instead you have just a three circle, which is a bit easier, and I call that Ikigai. So it's being financial independence and finding, reason of being. When you're financially independent, you don't need money. So instead of Ikigai, it's Ikigai. Anyway, now, how can I have the greatest impact? And I know we don't have time to go through this, so we're not going to do the whole chat thing. But think about it. This is, for me, the question that's driven most of my thinking in the past 4 years, I would say. How can I have the greatest positive impact? And me being here today with you guys is that. I'm not here to sell you anything. I did talk about my course, right? But the impact I'm hoping to have here is, like, I'm hoping that the information I'm sharing with you today will make a difference in your life. I'm hoping that by hearing what I'm saying here about impact, that it will inspire you to do something that has meaning and has impact. And I'm hoping that this effect will just compound on itself, and we're just going to help make the world a better place. So when Chris asked me if I could talk about index investing to you guys, I said yes, but I also said I want to talk about financial freedom, and I want to talk about maybe some other stuff as well. And he said, okay. So here we go. Impact. Now, there's something called effective altruism, which is sort of one of the answers that I've found to this question of how can I have the most positive impact. Effective altruism is about answering one simple question: how can we use our resources to help others the most? Resources including time, money, skills, freedom, right? And it's a movement that's growing around the world. It's not as big as financial independence, but it's powerful, and it's changing the world, probably more than financial independence. So if you're interested in doing good and doing something positive with your life, then I really encourage you to check that effective altruism website. And specifically for you guys who are sort of at crossroads where you can still make decisions about your career, I would say go check 80,000hours.org. These guys specialize in identifying the career paths that makes the most difference over the long term, that can really literally change the direction of humanity. And I'm saying this and it sounds crazy and all, but that's the real question. Like, how can I make sure, how can I contribute to world peace? How can I contribute to preventing the next coronavirus from wiping out, the economy and putting so many people into so much trouble and hundreds of thousands of deaths around the world, million potential, more billion, who knows, right? But how can I contribute, right? How can I contribute to some other problems, technology risk problems? I don't know if I said climate change, but maybe, there's, and also, biodiversity, the collapse of biodiversity, there may be some other problems, maybe smaller things, but at least, ask the question. And 80,000hours.org has a great way of making you think through those questions so that you can list the options for yourself, explore what really speaks to you, find something that matches your personality and your needs and your personal lifestyle, etc., and find that way that you have, that you're uniquely gifted to actually make a positive contribution. And I think I have one more link here. Yes, I would invite you to listen to Will McCaskill, the TED Talk. Again, I'm gonna copy paste this in the chat in a minute. It's 15 minutes, or maybe 12, but it's like just one talk. You'll see that these guys spend so much time thinking about how we can make the world a better place. What are the biggest problems that we're facing today? And it's not climate change, and it's not social justice. It's not what we talk about most in the media. It's other things. And he explains some of that in this short video. It's great. I love it and highly recommend it. And then finally, Will McCaskill. Right, this guy is young. He's younger than me. He was in your shoes at some point. He was, a young graduate, not even a graduate yet. He was just starting his studies, and I was thinking, okay, what can I do that would have the biggest impact in the world with my career, with my time, with my resources? Today is a professor of philosophy and research fellow at the Global Priorities Institute in Oxford. He wrote a book. It's called Doing Good Better, Effective Altruism and a Radical New Way to Make a Difference. Highly recommended. Great book. He's the co-founder and president of the Center for Effective Altruism, which we talked about earlier. He's one of the key person driving this whole thing, and an inspiration, right? He's the co-founder of 80,000 Hours and the director of Global Priorities Research Foundation. I did tell you earlier that there's my top two people that I recommend you explore a bit their life and sort of see if you can get some inspiration from them. But I would say him and Jack Bogle. Like for your finances, Jack Bogle. For positive impact, making a difference, Will MacAskill. These are the places I would start. And these are the things that I wish I knew when I was 21, 22. Right. So investing for freedom. Any questions?
Yeah, so I will, I'll say, because it's already 9, so everyone that wants to stay can of course stay and ask some more questions. This is where I will be leaving.
Right.
Thank you everyone for attending. Next Thursday is our next session, which will be about real estate at a younger age.
Yes.
And yeah, thank you everyone for attending. Thank you from Junior Consulting and from Hermes, and follow us on Facebook and Instagram and LinkedIn if you want to stay up to date with our events. Thank you.
Awesome. Thank you, Chris. It was great being here. Thanks for the opportunity. I hope this was useful. Everyone, feel free to connect. I've posted all the links in the chat. You can actually save the chat. So if you go click on the 3 dots at the bottom of your screen, and you can say save chat, you get everything on your side in a text document. And you can come back to it later. Yeah, again, like join the community, connect with me on LinkedIn, on Facebook, and let's continue the conversation there.